right, and welcome back to chapter 11, adjustments. So, the last thing that we did was take a look at depreciation and journalizing or using a journal entry um, to journalize depreciation, to record depreciation in your books, because there is no other way that we could manage depreciation without knowing how to record a journal entry. Okay, so that's why it's important that the accountant knows the accounting background, because they're going to be needing to know how to journalize a transaction between a debit and a credit. Now, of course, we have we have one more thing where as we go through the journals, right? How do I get back to those journals? You could do what's called a journal report. Okay, we could do what's called a journal report where we're able to view those transactions. So again, if I go to reports, okay, we're going to go to For My Accountant section, and that's where we get to view all of our journal entries that we made. Okay, so here, not who owes you, we're going to For My Accountant. Okay, right here, you get accounts, you get balances, and we get journals. Okay, so if I go ahead and click on journals, right, this should pull up all the journals that we've done in over the course of the year. So I put all dates. Here they all are. Okay, so the journal entries that I did for journal entry number 1, the inventory adjustment, the depreciation, it's all here. Okay, and the from moving from one account to another, it's all here. Okay, this is also looking at all the transactions behind the scenes as well. Remember, for every bill that we enter in, this is the journal entry for that. For all the invoices that we do, here's a journal entry for it as well. So again, this also keeps track of every single journal transaction behind the scenes as well. So this is where if you're unfamiliar of how a transaction works, every time you do you enter in a bill or things like that, here it will give you an overview of what that transaction is. So for example, when I purchased my cargo van, this is the journal entry, right? Okay, and I can view it if I want to. This is also, once again, where you can locate all of your journal entries that you've done. So it's really cool when you look at your journal entries, is you're also looking at the accounting behind the scenes. Okay, so that's that one there. All right, so there's another section in your book that talks about processing 1099s. That is going to be up to your type of business, whether you are going to have 1099 workers or not. So I'm actually going to skip this section because there are, a little more pressing sections in the chapter that I'd rather go over. But again, feel free to read those 5 pages or 5, 6, 7 pages or so about how to process those 1099s. They're really just going to tell you to gear towards this section under payroll. Okay, so if you click on payroll, you have your contractors here. So this is where you're going to process most of your 1099 workers here. Okay, so therefore right here you could go ahead and prepare your 1099 forms and so on and so forth. But it also goes into detail into the book, making sure that you know which 1099 forms to issue to which 1099 contractor, because every single one of them will fall under a specific category, whether it's miscellaneous or INT or the other one. right? So there's 3 types that you have to make sure that you know which form to fill out. Again, the 1099 worker should know what kind of 1099 work contractor they are. So they should be preparing those forms for you as well. But this one helps you prepare those forms and stuff like that in the payroll section under contractors, okay? So this is where you're going to be processing those 1099 forms. Okay. All right, so again, I'm going to skip that section and dive right into equity, okay? Now, equity is going to be one of those sections where we have to focus most on, because equity at the end of the given accounting period, you always need to adjust it, especially if we're looking at a sole proprietorship or any type of business that you are, especially including corporations. You need to pay close attention to equity and how to manage it. Now, as we know, depending on what kind of business you are, if you are a sole proprietor, your equity is going to come from your own investments or your owner's withdrawals. If you're a corporation, your equity is going to derive from your share stock, your common stock, your preferred stock, as well as your dividends, right? So it really depends on what kind of business you are looking at. But since this is a small corporation, we're just gonna act like it's a sole proprietor just for sakes, because in this class, like for the accounting class, we do teach accounting as a sole proprietorship more so than a corporation. Or just some kind of small kind of business. So in this case, that's what we're going to be focusing on, is the necessary components that are in your depending on what kind of business that you establish, you need to focus on what kind of equity accounts that you should have. So in this case, right, we're going to go ahead and first verify that we have the owner's, owner's equity, owner's draw, owner's investment, right? We should have created those accounts along the way, okay? So let me go ahead and put just owners, and let's see what happens. So here I've created the owner's draw. We have owner's equity and we have owner's investment. So we do have those accounts. So if you remember, we had to establish this in chapter 5. The owner's investment was from chapter 4, when we put money into the business, right? When we wrote a check for $50,000, and then on top of that, we also did one for in chapter 3 when we deposited the money into the bank. We also did an owner's draw there too. So we did create these accounts along the way. So that's what we have to ensure, that these 3 accounts exist right now. Okay. So yes, they do. All right. So we can go ahead and proceed with the next section here. Okay. Now that you establish those accounts exist for the appropriate business that you are, usually at the end of the given accounting period, it is practice that you should close out your equity at the end of every given accounting period. What does it mean, close out to your equity? It basically means that when you are keeping track of your equity at the end of the year, you need to take your owner's withdrawal and counter against your owner's equity. You need to take your owner's investments and counter against owner's equity, just so then once again you are at your appropriate amounts when you begin your equity for the next following accounting period. So that's what that section just looks for, is have you made the appropriate accounts for the appropriate type of business that you are. So now that we have done that, now it's the time to finally process the closing of the books. Now, closing of the books, here it is. These are your steps to help you process to close your books. So again, 10 steps to close your books. So again, this is going to be an additional extra step that you have to do as an accountant because you are responsible to close your books. So the first thing that we got to do here is we need to reconcile any cash credits or any loans, anything like that. So remember, that's why we did the bank reconciliation in chapter 7, right? We need to reconcile that, and it's very last because that's why I left chapter 7 or chapter 6 and 7 to be very, very, very last, okay? All right, because that is, we need to be, this is a bank reconciliation is indeed a adjustment entry that needs to be done at the end of the accounting period or at the end of the month, right? Because in this case, we need to make sure that when we go through our bank transactions, it's at the end of the month instead of in the middle of the month, right? Then second thing we got to do is enter any depreciation. So if you have any fixed assets, so we already took a look at an example of doing depreciation because the only fixed asset that we acquired in this Imagine Photography is going to be that cargo van, which we already took a look at an example of doing the depreciation journal entry, okay? Then number 3 says, if your business has any inventory, right? So that's why chapter 10 was also one of the last chapters because you do need to make sure that you do your inventory physical counts to ensure that do you need to make any inventory adjustments, whether it's physical count or whether it's value, right? Do you need to change the value? Do you need to make any inventory adjustments? So that's number 3, which we've already done, right? Then step 4 is going to be confirm any income and expenses that were categorized properly. So again, we already took a look at that earlier today too. Did you properly recategorize or categorize all of your transactions for your income and your expenses, right? So we've already saw that in the very beginning of chapter 11 to find any unclassified accounts, right? So we've already done that in chapter 11, right, the very beginning. And then number 5, if you are on an accrual basis of accounting, prepare journal entries to accrue any existing prepayments, revenues, and so on and so forth, right? So in this case, right, when you are the accountant, you're going to need to know what are those other adjustments that are necessary. So in this case, when you read chapter 11, there are that other list of why we do journal entries, right? We need to allocate our our prepaid accounts. We need to use it for any other non-cash transaction. So again, bad debt is a non-cash transaction, which usually happens at the end of the year, right? When you figure out that how much money that your customers are not willing to pay, then that's going to be considered an adjustment. Amortization, right, is another fancy word for depreciating intangible assets, right? So again, you need to be able to do that. And again, it's over here that you need to ask your accountant for help for this help. No, you don't need to ask your accountant. You need to be the accountant to do this part. All right, for step 5, right? What are those necessary extra adjustments that you need to complete? Okay. And then number 6 is going to be closing out your equity. So that's why I was talking about earlier. You need to establish what kind of business you are. Are you, in this case, we're looking at a sole proprietor / small corporations, where we are looking at owner's draw, owner's investments, and owner's equity, right? So in this case, we need to go ahead and close out those equity accounts so that when we start out the next accounting period, right, you are starting at a number in your owner's equity. Okay, so we got to close out our owner's draw because that reduces your equity, and we got to close out our owner's investments, which increase your equity. So that's going to be step 6, what we're going to do here. Okay. Then step 7 is going to be running your reports for and also verify that the accuracy of those adjustments. So making sure that those adjustments actually went through. Okay. And then of course you're going to print out your PDF files of the following things, such as your statement of cash flows, your balance sheet, profit and loss, trial balance, all of those, right? Your financial statements, right? Which we took a look in chapter 7, right? We know exactly what those are. So after you've done your adjustments, you want to make sure you've done them correctly, and then run the reports and then print them out. Okay, so again, making sure that your trial balances are balanced, your accounting equation is good, so then you have it for the end of the to wrap up the end of the year reporting season. Okay, and then number 9, if possible, back up your existing file by exporting all the data into an online backup and restore it. So in this case, for example, since everything's going to be online, you can also use a cloud-based services that Intuit offers for you. It's up to you, or you can literally go through every single section in your books and just export them digitally or export them through Excel or PDF. So you do have that option as well, okay, just to back it up, okay? And then last but not least, you're going to set the closing date, which will lock the file, and then you're going to share this file with your accountant so they can go ahead and help you file the taxes that you need to get done. So again, we are halfway through the closing process, right? We've already done all the way up to step 7 here, okay? Or step 6, we're going to close out our equity accounts, okay? And then we will do the rest, okay? So let's go ahead and close out of those equity accounts. So again, we are going to be processing where we're going to close out our equity as a sole proprietor. So make sure you're looking at the correct section here, because basically what it's going to tell you is you're going to do another journal entry to clear out your owner's draw and your owner's investments, okay? So in this case, that's what I'm going to do here. I'm going to do another journal entry here, okay? It says right here, results might vary depending on if you kept up with this class, okay? The best way I'm going to be able to look up this information is through either a trial balance or a balance sheet, because the balance sheet's going to give you all the accounting information. So make sure you do run it from January 31st just to get those numbers. And once you get those numbers, then you can go ahead and proceed with closing out your journals, okay? All right. Now I'm going to go ahead and run that report real quick. So let's do the balance sheet report. Okay, so reports. Okay, it's going to be a favorite balance sheet. And I want to make sure that I have a custom time frame between January 1st all the way to January 31st, since we're going to close out the accounting period at the end of January 31st. Okay, and refresh. Okay. So here is my section here. Let's scroll down right here. Section right here for equity. Okay. I currently have $3,010.75 in my opening balance. Now, what is this opening balance equity? Now, opening balance equity is going to determine that at the end of your accounting period, accounting cycle, right? This should be automatic to you. where your income and your expenses are going to close out to your open balance equity, okay? So that is important that you need to know, because in the accounting program, you're going to have to manually close out all of your income and all your expenses. Guess what? QuickBooks does it right away. As soon as you enter in an income and expense, it closes it out immediately to your equity. Okay, now in this case, we have it as the spot is called open balance equity. It could also be known as your retained earnings. So you could rename your open balance equity as retained earnings. Okay, but in this case, I have two separate ones for retained earnings and so on and so forth. And right now, my retained earnings has 0 in it. But in this case, open balance equity is what you began your equity with. As you can see, we have an owner's draw for $4.10. We have an owner's equity for $51,500, and we have retained earnings at 0 and a net income right here for negative $10,104.53. Okay. Now, in this case, my owner's investment is already into my owner's equity. Okay. Yes. Let me see. So in this case, let's see. 30/10/75 for opening balance, credit for $4.10. Owner's equity or retained earnings should be a credit of $5,550.90. So in this case, I don't have owner's equity as that number. So let's see. We're going to go ahead and just do this. Now, if your results may vary, right, you just follow through what you should be having. Owner's investment should have been $52,500. See, that's what I mean. Some of my numbers are a little off. So if you, let me see if there's anything else in here. Okay. Okay, so let's go ahead and run my trial balance real quick. Maybe I could be able to find all my equity numbers there. So here, I'm going to go to for my accountant, and I should find my trial balance here. Okay. For the given specific time frame, from January 1st to January 31st. Okay. So here's the and then run report. So here, let's see, my equity. That's a lot of okay, so cash, checking, okay, so here, opening balance equity is currently at 30/10 here. Owner's draw for negative $4.10. Owner's equity should be $51,500. And that's it. That's all that's telling me right here. So in this case, I'm going to go ahead and proceed with my journal here. So again, I'm going to actually go back to my balance sheet to copy all those numbers. So again, results may vary depending on if you whether you followed along or not. So let me just do that balance sheet one more time to copy all those numbers down. For the accounting period of January to January 31st. Now remember, your numbers. Actually, is it for January? Let's see. Yeah, January 31st. Okay, so you got that 3,010 for your opening balance. Okay, you're going to close that out to your equity, then your owner's draw for $4. and 10 cents, and then you're going to go ahead and put that all into your equity for your owner's equity for 51. Okay. Now in this case, you need to know the rules of how to close out your equity accounts. So in this case, you're going to need to know how the flow of a transaction is going to work. So let's go ahead and do my journal entry here. Hold on. I feel like I'm supposed to be doing at the end of the year. Okay, let me see. 10, 3, 10, owner's investment. Okay, hold on. Sorry, guys. Let me go back and let me try the end of the year, see if that will make a difference. Because I think we're supposed to be closing at the end of the year. So let me see if I were to process this for all dates. Let's see. All right, so you get your 3,010, your 1,500, your 1,000 of owner's investment, your 410 here, and I think this is what we're supposed to do because the owner's investment is $1,000, and you got your 51,500 here. Okay, so we're going to go ahead and close out all of these accounts here, okay, to put it into owner's equity. Okay, so let's see. Okay, so let me do owner's investment for that $1,000. Okay, so let's go ahead and do that journal entry. I'm just going to do it for the end of the year. Okay, journal entry. And today is going to be, like we've mentioned, we're going to just do December 31st at the end of the year. Okay, journal entry. This is going to be subjective. So once again, how do we understand how owner's equity works? Well, in this case, we have to look at what these transactions are going to do. Opening balance equity, right? That's what you started out with your equity. So right now, I currently have a credit balance in my open balance equity. I need to transfer that into my owner's equity. So in this case, you could do multiple journal transactions if you need to, just to make sure that you are putting everything in the correct spots. So in this case, I'm going to go ahead and put in my open balance equity. So here, open balance equity. Right now, it's currently at a credit. I need to debit this account to increase my owner's equity, right? If you're able to do everything in one journal entry, then you know, so on and so forth, right? So I can be able to just understand that, right? That this is going to credit because I'm trying to increase my owner's equity. Yes. Question?
Yeah, is it $3,010.75 or is it 3,010?
Yes, sorry. I missed that 75 cents. 3,010.75. Okay. And then since it's going to increase my equity, right? I can put my equity account here if I wanted to and then just continue the rest of my journal entries exactly like that. Or if I can do the math in my head and know that, okay, I'm going to credit my owner's equity. What's the next one? I'm going to put my owner's investment, which is going to increase my equity as well. I can go ahead and just figure that number out and be able to process that number later on. Now, in this case, I'm going to, since I already know what I'm doing, an owner's investment is going to increase my, so my owner's investment is going to increase my equity. So therefore, right now there's a, right now it is a credit balance. So I need to debit that balance in order to credit my owner's equity. Okay. And then I know that my owner's withdrawal is going to decrease my owner's equity. So in this case, owner's draw for $4.10. Okay, will decrease. So therefore, when I do my journal entry, I'm going to credit my owner's draw and I'm going to debit my owner's equity, which is going to reduce my owner's equity. So then once I get there, I'm going to go ahead and put in owner's equity, right? Because that's where I'm going to deposit everything. Okay? And it should be for 4,000. Nope. 4,000. Wait. No. I'm on the right side. Right here. $4,006.65 to the credit side. Okay? So therefore, everything looks good now. So I'm going to transfer all that in for it because I'm closing out my accounts. Description, you could say close out, close out equity. Now, here's the thing that we have to know. Do not touch your net income. Okay? Do not touch your net income because that's automatically going to be put into your owner's, well, in this case, retained earnings later on. Okay? And then, of course, class. This is going to be overhead or admin. Overhead or admin. I'm going to do overhead since it applies to both. Okay. So once everything looks good, I'm going to go ahead and click save and close. Okay. There you go. Okay. So if I run my reports again, you're going to see that your equity balances are all going to be transferred. So let's go ahead and run that report one more time. And then this is what you're going to see. Okay, let's do it again. Let me change the dates. Okay, let's do all dates. Actually, no. Let's do custom for January. First, all the way to December 31st. Okay, and run. So you should see that your numbers should zero out everything. So we zeroed out our opening balance equity. We zeroed out our owner's draw, and we zeroed out our owner's investment. So now I should start out with $55,506.65, which is exactly what I should be ending with. Okay, which is right here. Oh, I'm off by $1 and something right here, but that's what you should be ending with at the very end, is that 55, 506.65, right? It will just depend on what your numbers are. Okay, so in this case, your numbers may vary, but this is what you should see for your reports. Okay, so there you go. Now that I did step 6, I can now prepare the reports that I need for step 8 to print them out. So then step 9 is to go ahead and finish up closing the books. Okay, so again, I need to set the closing date. Now, what I recommended you to do is wait till the very, 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 very end to go ahead and set that closing date, because you don't want to lock yourself out. But in this case right here, this is what I need to mention to you. Okay? We said that at the end of every accounting year, since you put into your whatchamacallit, you put into your QuickBooks that that you are going to be, you set the accounting period as starting as of January. So do you remember when we set our accounting books, right? We went to here, I'll show you. So in this case, account settings, okay? And we went to advanced settings, where that last section for your books is to determine when your accounting period starts. So right here, we said that we started on January, and our fiscal year is going to start on January. Okay? So this is important because when we set it up this way, right, that means the next year that we start our books, it's going to automatically convert that net income into your retained earnings account. So in this case, what am I talking about? So again, if I ran this report, so this is the trial balance for this year, right? If I were to say I want to see next year's, okay, so if I want to see 2023 January, and I want to see okay, and I run my report, then this is what you're going to see. Net income becomes retained earnings. Why? Because that is exactly what I was talking about. Your net income is going to automatically convert into your retained earnings. Since we've already mentioned that your income and your expenses are automatically closed out for every journal entry that you put in there, right? So now I'm in January of 2023. It automatically had convert my net income into retained earnings, right? And that's what I was getting at, is that you don't need to convert that. However, if you feel the need to close out your retained earnings into your equity, then you can go ahead and do so, right? So you always want to do that at the next following year, because again, your retained earnings, right? You're going to have to make the decision. What are you going to do with your retained earnings? Are you going to hold on to that Are you going to hold on to that retained earnings? Are you going to reinvest into your company? Or are you going to pocket as a profit? Now, in this case, I took a loss because it's negative, right? Negative 14. So that means the company is going to end up paying for that, okay? Now, if you're a corporation, right? What do we know about retained earnings? Well, retained earnings, you have a decision, right? You can either reinvest it into your company once again, or you can disperse the profits through dividends, right, to all the people who own common stock, preferred stock, or whatever kind of stock that they put into your company, right? But right now I have a negative, so therefore this number is going to be taken out directly from my owner's equity account, right? And you normally do this. Usually it's supposed to be done at the end of the year, but again, since it converted it already, then you're just going to have to go ahead and that's the first thing you're going to do when you're going to process the next accounting year is what are you going to do with this retained earnings? Are you going to choose to hold on to it? In this case, I have a negative, so you're going to close that out to your equity in the very beginning of January, right? And then as you notice here, I have a new net income because that's where your new line of expenses and your new line of income is actually going to start calculating from there for the year 2023. So again, everything is being processed for you automatically to go ahead and suit for and make it much more easy and convenient to go ahead and close out your books for you. So in this case, that's why that's one of the things about the accounting program is that it helps you save time right here, especially for those. That's what I mean, like if you are using the accounting program and you're not familiar with the accounting behind the scenes, you don't necessarily have to. That's why it says ask your accountant if you are needing help. But in this case, it kind of does the work for you. All you need to know what the standard procedures are and especially journalizing your entries. So that's all you really need to do. So that's why you want to be very, 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 you don't have to be very careful here. But it does ask you to make sure that you do check up with your accountant, but it does the work for you. So you don't have to do it. And again, when you start the next accounting period, right, you're starting on a clean slate and you're ready to go. Now, the last thing that we were talking about is to set that closing date. Now, what does that do? Setting the closing date locks your data file up. So again, how do we get there? You go to the gear icon and you go to account settings and it's going to be under advanced, okay? So under advanced, right, it's going to be under the section right here for accounting and you have close the books. Now remember, if you do select close that books, you're going to have to set the closing date. Now, friendly reminder, do not ever set the closing date ahead of time. I recommend that you wait until the very end of your accounting month to go ahead and set that closing date, okay? Because this is going to ensure that nobody else who has user privileges is able to access your file in a closed accounting period, okay? Now, in this case, what's the purpose of a closing date? If you remember back in chapter 2, when we talked about setting up the closing date, what it happens is at the end of every accounting year, what is your assumption? You are going to be filing for taxes. So you do not want any entries after you close your accounting period because whatever happens at the end of December 31st, you need to be completely done with your books by then, okay? So that's why they usually let you do this, of course, January 1st, of course, so you can get that last date of December 31st in there and be able to process everything else and also get that retained earnings in there as well, okay? But at the end of the day, closing out your books is for the mere purpose of making sure that nobody adds any extra transactions, okay, for the new year when you have to file for taxes for that closing year, right? So once you finish filing for taxes, what you're going to do is you're going to save all your documentations and back up everything, right? Let your accountant see the work or grab a copy of it, and then you'll be able to proceed the rest of your books later on when you come back to your QuickBooks. You just basically you're just going to undo that closed books and then proceed with the next year since everything's automatically closed out for you, as we saw, right? And I have zero net income. I have everything converted into retained earnings, and I've already done my job as to, do those adjustments where I close out my equity. So I'm already ready to start my new accounting year. Okay. Now, here's also something that you should also know as well is that, again, once you've submitted your work, right, submitted your company file to your accountant, that is it. You can't make any more adjustments after that. Now, if like we've seen before in chapter 5, what if you need to make minor changes in an adjusted accounting period? Then what you're going to do is you're just going to enter that transaction into the new current year to and just make a note towards it for the closed accounting period. That's it. Right? You have to move forward, not move backwards. So in this case, setting the closing date only prevents your users to have access to this. Now, guess what? Only the admin or the bookkeeper, okay, has access to this, okay? Any other regular user will not have access to this closing date section, okay? So that's why it's very important that you know what your role is when you're creating your profiles, okay? That's why in the very beginning, when we went through the whole entire interview, you need to make sure you are the admin or the bookkeeper / accountant, because then you will have full access to everything that you need to see in QuickBooks. And then you can create those other users to, facilitate the certain sections of your QuickBooks. But if you were to set a closing date, right, let's say I want to make it December 31st of this year, okay? I'm not going to set it, but in this case, it's going to say right here, allow changes to be made. No, but I also want to say, it says allow changes after viewing and warning with entering a password, okay? So again, if you are the accountant, this is going to ensure that you, the accountant, is the only one that's able to access this file. So if you're going to set a password, that means if you're going to make any changes to the closed accounting period, it's going to give you a warning sign and it's going to ask you to enter in a password so you are able to verify that you made those changes to a closed accounting period, okay? So that's just what that is. But like I said, I'm not going to set a closing date because we are officially done with chapter 11, okay? So I'm not going to set a closing date and, proceed, okay? So once again, that is it for chapter 11, okay? So, yeah, any questions for chapter 11? Okay. So now we're going to go ahead and go through the multiple choice section here. All right. So right here, your job is to answer the following or select the following answers from the, select the best answer for each of the following. Okay. Number 1. Okay. Which of the following tasks does QuickBooks Online perform automatically at year end?
Would it be C?
It will be 100% C, where it's going to adjust the balances in retained earnings account to include the net income or loss for that year. Yes, it will do that for you automatically, so you do not have to do that, okay? Number 2, entering a date in the closing data field, okay, accomplishes which of the following?
C.
It locks the data file so that so then no unauthorized users can add change or delete any transactions. Yeah. So that's a very important thing there. Number 3, which is not true about $0 checks? Not true about $0 checks.
C.
C, right? You can send the check to a supplier, right? In this case, $0 checks. You're not spending any money to anybody. You're not sending it to a supplier. You're allocating it to your I believe it was some kind of adjustment person, right? Which it doesn't really do anything. But in this case, you're going to not send a check to a supplier, right? Because what you're doing here with a $0 check is you're just converting or you're recategorizing your items and accounts. Okay. Number 4, to make an adjustment to items as well as their associated accounts, create a
C.
A.
Okay, so I heard C and I heard A. Now, A, journal entries are strictly for accounts and accounts only or categories. Okay? This one is asking to make an adjustment to items as well as accounts. So in this case, the $0 entry allows you to have that section where you can recategorize your items. So in this case, A only does accounts. Okay? $0 entries does items and accounts. So in this case, letter C is the correct answer. Okay? You would use a $0 entry if you're recategorizing items and accounts. Number 5, okay? At the end of the year, you should perform the following.
It's going to be D.
D is the correct. All of the above. You're going to enter in any depreciation, right? That's like step 2 or something like that. B, you're going to perform any physical inventory, which is step 3 or 4. And of course, you are going to, if your business is a partnership, okay, you're going to enter in a journal entry to distribute the partner's profits and so on and so forth, right? So in this case, this was step 6. Okay, so again, this is the steps of the account of closing the accounting to close out the books, and they all are going to be things that you need to perform. Okay, number 6, to track payments to 1099 vendors and print 1099 forms accurately, you must complete all of the following except. Okay, so it's another negative question here. You do everything except
B.
B. Set up an account and settings to track accounts lined to the 1099 related services. Yes, you are not going to make a separate account for 1099 workers, right? You're just going to list out what they did for you, and that's it. You don't need to make any separations between that. Okay? Because your 1099s are gonna be doing the same services as your employees, right? You don't need to make any separations between that. Okay? You just need to code them to the correct person is all you have to do. Okay? Number 7, the IRS may reject a 1099 if you submit it.
C.
Okay, for number 7. 7, C is correct. If the taxpayer ID is incorrect. So in this case, if you put your taxpayer ID incorrectly, then you'll get flagged. You'll get flagged for filing as an incorrect entity, right? But this is also talking about if you entered in somebody's social security. So again, 1099 contractors must either be using their social security, or they can have an employer identification number. They have to be legitimate, a claim as a independent contractor, a 1099 worker. All right, because if they're filing, if they say they're a business, if they say they're their own company, and they act like a 1099 worker, but really they don't actually file taxes at the end of the year, this person can get in trouble. So that's why it's very important that when we set up our individual vendors, right, there's a section that says right here that do we keep track of them as a 1099 worker. And if you click that, what it does is it takes that person's social security number or identification number, and it runs it through the IRS to ensure that this person is truly their own individual separate company, or they are going to be they claimed as themselves as a 1099 contractor. So that's why it's very important that you have the the taxpayer identification correct. Okay. And that's over here. The phone number for the 1099 vendor is incorrect. Obviously, phone numbers don't matter to the government. This is the IRS that we're talking about. Anybody can put anybody's phone number down, so that doesn't even matter. Let me see. The email address to the 1099 workers invalid. Again, email addresses doesn't matter to the IRS. And again, the vendor did not fill out a V9 form. In this case, V9, I'm sorry, it says a V9, W9 form, okay, is just so that you can ensure whether that person is going to be claimed as a 1099 worker, independent contractor, or whatever there is. So this one, it doesn't really necessarily need to happen. If they already known as themselves as established as a 1099, all they have to do is come up to you with their 1099, and then you just file that form in your system, right? The W9 is just to ensure, are they a 1099? Can you claim them as a 1099, and so on and so forth. So in this case, not necessarily important, but definitely your taxpayer identification, it must be correct. Okay. Number 9, which is not true about setting a closing date. So not true. So false.
D.
A closing date can only be set by an administrator or accountant user. In this case, it would appear on their profile, but I mean, the owner can be able to set that date as well. Okay, but it's just, this is not necessarily true. But what I was trying to say is that you have to be the admin in order to set that password. Okay. Let's see. You said A. It is required for all QuickBooks Online files. No, it is not required. Right? For me, I didn't have to set the closing date. Okay, so this one says that this is more of a command, right? It is required for all. No, it's not required for all. Okay. Okay. Number 9. Remember, this is supposed to be not true. Okay, right? And it's true, right? That yes, your accountant or the administrator has to be the one to close the date. Number 9. When you depreciate a fixed asset, you should categorize the entry to
D.
D is correct. Both B and C, the depreciation other expense account, and of course the depreciation fixed asset account, also known as your accumulated depreciation. Okay. All right. And then number 10. Okay, number 10 asks, which of the following is not true about 1099s? Okay, so again, a lot of false questions, right? A lot of not questions, negative questions. Number 10, which the following is not true, so false.
C.
Letter C is correct, okay? The 1099 wizard helps you prepare the 1099 MIS or miscellaneous 1099 NEC and the 1099 NINT, okay? And the 1099 DIV, okay? It doesn't help you process that, but it does help you prepare them. Okay, because if you go to your payroll, you click on that button to click on prepare your 1099s, but it doesn't necessarily mean it's going to do it for you. Okay, it only helps you prepare it, not help you do it. Okay. Number 11, which of the following is an example of a fixed asset? So this is according to QuickBooks, of course.
A.
A, correct. A $5,000 high-speed copier. So in this case, I did not mention it in the section for depreciation. They do say there is a threshold of a price value. Okay. Now this is because most companies are usually going to be, well established, or they are going to be some type of form of business where, it's going to be either a corporation that would most likely use QuickBooks because of the vast majority of easy accessibility and be able to enter in transactions and be done. So in their perspective, they put a threshold on the price value of an asset. Okay, so in this case, I believe the threshold is over $2,000. Okay. However, if you are a small business, a $2,000 or less than $2,000, a $500 printer is going to be deemed as something that is for surely going to be considered a fixed asset to you, because as a small business, your numbers are scaled completely different than a corporation's, right? To a corporation, $500 is nothing to them. For a small business, right, $500 is a lot, especially if you own an asset that's about $5,000. So in this case, right, that's just because that's what QuickBooks says, is that's usually the determination threshold. I say differently. Depending on the type of business that you are, a $1,200 laptop computer is going to definitely be a fixed asset to you. That is not an expense that you can just incur once for that month. No, a $1,200 laptop computer is a lot to a very small business. So in this case, I do disagree that it can be A and it can be B, but it's definitely not going to be a box of paper. That's going to be an expense, and all of the above is obviously going to be not the correct answer, right? Because a box of paper, we just said, isn't going to be a fixed asset. But I definitely think a $1,200 laptop should be deemed as a fixed asset depending on what kind of business you are, okay? So in this case, that $2,000 threshold doesn't matter in terms of what kind of business that you are, because we're not looking at a grand scale, right? We're looking at a small business, a small corporation even, right? That this $1,200 laptop should affect your business pretty by a lot. Okay? So last question for this section here is, which of the following is false?
C.
Letter C is false. Journal entries can be used to transfer sales from one product or service to another. So in this case, remember we said journal entries are strictly for just accounts and accounts only. Okay? It is not meant for categorizing any any item which comes from sales and from any product and services. Those are your items. So again, you won't be able to use a journal entry for that. Okay? But of course, you can use it to reallocate anything from one class to another. You can also do it for from another account to another. You could do it to move funds. I already said that, account from another to another account. And again, you can also be able to do it for the debits and credits that are required to balance. So making sure that you do know the accounting behind the scenes, or you know how to use the journalizing system where you're needing to do the double entry system, where you're going to affect, if you're going to affect one account, you need to know how to affect the other account. Okay. All right. So that concludes QuickBooks Online.